the Moneyweb Crypto Podcast, where we discuss all things crypto related. Your host, Kieran Ryan.
Does Africa need more local currency, stable coins? Who, you might wonder, would want to hold Malawian kwachas, Ghana cedis, or for that matter, South African rands in stablecoin form? Well, it turns out there are good reasons for that, as we're about to find out. The stablecoin market's grown to well over $300 billion, but more than 98% of that value is still denominated in US dollars. And the two big ones there are, of course, Tether and USDC. Now, a new report from Standard Chartered and Zodia Markets argues the next phase of growth may come not from replacing the dollar, but from enabling local currencies to participate in digital payments, cross-border trade, and corporate treasury management. Interestingly, several African countries, including Ghana, Rwanda, Namibia, Senegal, and Cote d'Ivoire, are identified in the report as strong candidates for local currency stablecoins. Joining us today to discuss this and what it could mean for African finance is Rochelle Macaulay, Managing Director and Head of Banks, Broker-Dealers and FinTech for Africa at Standard Chartered Bank. It's an interesting report from Standard Chartered. Now, you're arguing that stablecoins are becoming infrastructure rather than simply crypto assets. Now, why is that distinction important, and should we care about this?
So when most people think about stablecoins, they still think about crypto trading. But what's changing is that stablecoins are increasingly being looked at as a way of moving money more efficiently. So in practical terms, they can help businesses settle payments faster, manage liquidity more effectively, and move funds across borders with less friction. For consumers and small businesses, the real benefit isn't the technology itself. It's whether payments become quicker, cheaper, and easier to access. So that's particularly relevant in Africa, where cross-border payments can still be very expensive, fragmented, and dependent on multiple intermediaries. So importantly, it's not about replacing banks or local currencies. It's about whether stablecoins can become part of an underlying infrastructure that makes payments work better in the future. So stablecoins' ability to support settlement outside traditional payment system hours is a really significant advantage. So any corporate or institution chasing cutoff times can relate to this. I can give you some practical examples of use cases.
Yeah.
For example, diaspora remittances into local wallets at a lower cost and faster speed, cross-border SME supply payments without corresponding banking cutoff delays, regional trade settlement in trusted local or regional digital currencies, corporate treasury and intercompany liquidity movements with better visibility. But that said, adoption will only scale where users have confidence in the currency, the reserves, the issuer, and the redemption process. Ultimately, stablecoins should be viewed as a regulated payments infrastructure opportunity rather than a standalone currency replacement story.
Right. Now, we're familiar with the business case for stablecoins, cross-border, remittances from people from abroad working in South Africa, and they want to send money back to Zimbabwe or wherever it is. It's very low cost compared to the banks, and it's very fast, as you've already mentioned. And the other thing that we have come across is treasury management. This is an interesting one because that involves businesses. Now, the scenario that I've often mentioned is you're a business in Malawi or in Ghana, and you have you're sitting there with a big float of Ghanaian cedis or Malawian kwachas. Why would stable coins be interesting for you from that point of view?
Stablecoins can represent a way to actually move trapped cash out of markets as well. And if you have a corporate treasury where you've got various pockets of liquidity sitting in different markets, you can also move your liquidity around without having to go through traditional payment systems. There's still an FX leg, but you are not reliant on cutoff times. You're not reliant on, in some cases where markets are unregulated, which is not what we're advocating. You're able to move money cross-border without going through where there's regulatory friction. We are seeing use cases, particularly and this is not to do with local stablecoin, but on the USD stablecoins, we're seeing in African markets a way of moving liquidity out of trapped current countries at the moment. But we do see local currency stablecoins as a way to actually just move money faster with less friction and at a lower cost. And it makes managing pools of liquidity within a company much more easier.
One of the cases that we have come across before is, again, give this example. You're a company in Malawi, let's say. In 1 year, I think there was an instance, and this wasn't recent, but a few years ago, the Malawian kwacha depreciated like by a quarter against the US dollar. So if you're a company operating in Malawi and you're sitting with kwachas and you can convert those to US dollar stable coins, you're actually hedging yourself against that local currency risk. And then when you need to spend it, you can just off-ramp it back into kwacha again and spend the money in the local economy. Is this something that you are finding? Because you've got quite a footprint in Africa.
We are finding that a lot of the corporate clients are doing this. So some examples are, particularly in Nigeria, you're seeing manufacturing companies, for example, doing this, using stablecoin for this exact reason, because at one point the Naira depreciated from 400 to 1 to 1,400 to 1 on the dollar. So look, that currency has now stabilized a little bit, but you actually see stablecoin adoption for this use case in most of the countries where the volatility of the currency is highest, and there's protection against your local currency depreciation by being able to go in and out of local currency very, very quickly. If you had to do this typically over a normal traditional banking rail, you have to have corporate accounts typically with a bank. You have to have trading lines with the bank, so settlement lines to do spot FX. So it's very clunky to be able to do this. Whereas with stablecoin, you don't necessarily need to have all of that infrastructure in place. You don't need credit lines with banks. You don't need to be banking with banking partners that support FX conversion. So this is very much a use case, and it's typically for the much smaller or medium-sized enterprises that are not necessarily set up with traditional banks where they have access to this type of infrastructure.
Several African countries, I'm talking about the report here, you identify several African countries that are leading candidates for local currency stable coins. So we mentioned there's Rwanda, there's Cote d'Ivoire, there's Ghana, and there's a few others. South Africa is not on that list. Okay, we already have a few ZAR stable coins, but what makes Africa attractive for stable coins, and what is South Africa missing that it doesn't need more, in your opinion?
I think it's important to not see the table as a ranking of the continent's most advanced economies. The report is really looking at where demand for local currency digital settlement could be the strongest. So countries like Ghana, Rwanda, Namibia, Senegal, Cote d'Ivoire stand out because there's still significant gaps in the financial infrastructure, also gaps in cross-border trade processes or payment efficiency. So that actually creates a stronger incentive for new solutions. Countries in the CFA franc zones, for example, may benefit from a more stable regional currency framework, which can make cross-border payments easier. So South Africa is different. It already has a really relatively sophisticated banking system. In fact, I'd say very advanced banking system, probably globally. Deep capital markets, well-developed payment infrastructure. 75-80% of South Africans are banked in the traditional banking segments, so they don't actually need access to wallets and mobile money to be able to bank. It's really around where the use cases are the highest, and that's why the ranking of South Africa is probably lower. So the key distinction is between where demand may be strongest today and where large-scale issuance or adoption may ultimately emerge. But I don't think the best opportunities are necessarily in the biggest economies. In this case, the better candidates may be markets where there's more payment friction, currency structure, and regulatory issues there. But we will see adoption the highest in countries where, everything comes together. So where you have currency structure, regulatory readiness, and adoption amongst, I think, individuals across the economy and corporates where they understand digital technology. So if all of those three things come together, then we'll see adoption rise. But I think definitely in the case of South Africa, the need is probably not as high as some of the other African countries.
Right. It's hard not to think about the African continental free trade area. It's been spoken about a lot for a long time, but it does seem to be gathering a bit of pace. This surely would fit into the ideals of the free trade area that's been proposed, that we would have this ability just to move money without having all this friction and these barriers and these off-ramps and on-ramps and fees, big fees. Oh my goodness, you look at remittances and the World Bank keeps an eye on this all the time. Sometimes you're paying 20% in fees for cross-border remittances. So is this going to be a solution for intra-African trade? That's my question.
I think one of the biggest challenges in Africa trade is moving money across borders can often be more complicated than moving goods. And if you look at high-risk jurisdictions across Africa, there's also been a reduction in the number of correspondent banks that actually support those markets. And then the banks that do support those markets charge an exorbitant amount of money because of the risk management, and also because they're the only one or two banks in those markets, obviously less competition. So today, many transactions passing through correspondent banking networks have to also route through hard currencies such as the US dollar, even with both trading partners are based in Africa. Currency stablecoins could help simplify that process by allowing businesses to settle closer to the currencies that they actually use. There are fewer intermediaries and less conversion steps, and this can reduce costs and significantly improve speed. It's important under AFCFTA because where the goal is to make it easier for African businesses, especially SMEs, to trade across borders and participate in regional supply chains. So I don't see stablecoins replacing initiatives such as PAPS. Rather, they can complement existing systems by providing additional options for near real-time settlement. Ultimately, the biggest opportunity is probably improving liquidity and efficiency, not creating another speculative asset. But 100%, I think, along with PAPS, stablecoin can really help improve efficiency of intra-Africa trade.
Now, banks were initially, they were seen as potential losers from stablecoins, but Standard Chartered is now obviously researching and investing in this space. Just cast your mind forward a little bit here. This is a subject I think a lot of us are interested in. What is the future of banking? What is it going to look like? And tell us how you think, at Standard Chartered, your thinking has evolved around the stablecoin space, and what role do banks expect to play in this stablecoin ecosystem?
So the conversation has evolved quite significantly over the past few years. Initially, there was concern that stablecoins might displace deposits or bypass traditional banking channels. Today, the discussion is more focused on how these technologies can be integrated into the financial system in a more safe and regulated way. As a bank, we recognize that clients are looking for faster and more efficient ways to move money, to manage liquidity, and to access digital assets. So the question is no longer about whether digital assets will play a role, but how that role can be delivered responsibly. So banks still have a critical function, in my view. They provide trust, compliance, risk management, governance, and long-standing client relationships. So those capabilities become even more important as digital asset markets mature. For Standard Chartered, the focus has been on helping clients navigate this evolving landscape securely and within a regulated framework. So through initiatives such as Zodia Markets and Zodia Custody, we are building capabilities that connect traditional finance with emerging digital infrastructure. I see the role of banks as kind of bridging these two worlds together rather than choosing one over the other. A good example is our recently announced partnership with Circle. For your listeners, Circle is the issuer of USDC, which is one of the world's largest US dollar-backed stablecoins. So we've partnered with Circle to connect traditional banking services with digital asset and blockchain infrastructure, because our partnership enables institutional clients to mint and redeem USDC through a kind of bank-led service model. So that eliminates the need for separate client onboarding directly with Circle, for example.
Now, regulation plays a part in all of this, and the report touches on this. You just recently had the passage of the Genius Act in the US, which is really addressing itself to the emergence of stable coins and the kind of backing that stable coins must have. People are very, very interested in this. They want to see that if they're buying a Tether or a USDC, which is issued by Circle, that your money is actually backed by something solid. So maybe talk about that aspect of it and what African regulators, if they're going to adopt local stable coins, how are they going to look at this, or how should they look at this infrastructure and this regulation?
Yeah, so, I mean, you're very right. The technology is no longer the biggest question. I think the bigger issue is creating, and I think this is a very important word, trust. and regulatory certainty for businesses, consumers, and institutions, so you can actually participate with confidence. So the significance of the Genius Act is that it highlights what institutional adoption requires. So clear rules around reserves, transparency, supervision, redemption rights, and then also consumer protection. For African regulators, the priority is establishing clarity around who can issue stablecoins. So there's still quite a lot of regulation across Africa, looking at VASPs. So that's virtual asset service providers, still in progress. I mean, Kenya, I think, has just launched their regulation guidance this week. We met with the central bank and it's still quite broad. So as this develops in the market, they will be issuing guidance notes to actually try to bring the regulation into a line that actually works for everybody. The regulators need to consider issues as well, like such as anti-money laundering controls, cybersecurity, operational resilience, and then interoperability with existing payment systems. So, and this actually has broader financial stability implications. So the risk of inaction is that USD stablecoins becomes the default digital layer in Africa. And this could actually deepen digital dollarization. It can also reduce monetary policy effectiveness and weaken local financial market development. So these are real concerns that many central banks across Africa are already focusing on. I think every market will have its own considerations, particularly where currency volatility or capital controls exist. So the goal shouldn't be to copy another jurisdiction's framework word for word, but to really design regulation and provide a framework that works for your particular economy and within the your existing regulation as well.
Very interesting. So if I'm to summarize this, Rochelle, we're looking at a market which is going to be, there's going to be a lot of choice. You're going to have a lot of choice in the terms of currency, in terms of stable coin. You're going to have local currency stable coins. You're going to have US dollar, maybe European stable coins. They're all going to be competing. And so it's going to be a very rich, and there might be arbitrage between them. You know, people will, if the fees are a bit lower with one stable coin, they'll go there rather than another. And I could foresee maybe Standard Chartered issuing its own local stable currency coins, right?
Yeah, I mean, I think a good example of where this is emerging is we're working with central banks. In Hong Kong, we recently announced a partnership or joint venture with Anchor Point, where we're a majority shareholder, and we've been granted a stablecoin issuer license by the Hong Kong Monetary Authority, HKMA. We're going to launch a regulated Hong Kong dollar-backed stablecoin. So this is a real tangible step in building a secure tokenized medium of exchange for a digital economy, which facilitates payments, but it's backed by the central bank. So we're seeing a meaningful shift in how markets are evolving. And I think it's quite important for some of these central banks to really think about how they can launch regulated stablecoins backed by real reserves that participants can actually trust in.
We're going to leave it there. Thanks very much for joining us. That was Rochelle McCauley of Standard Chartered Bank. Thank you for your time, Rochelle.
Thanks for listening to the Moneyweb Crypto Podcast, hosted by Kieran Ryan. To listen to our other podcasts, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates.